In this lesson, we're going to be looking at the three main financial management decisions. We've already said in corporate finance, there's three primary decisions that we need to make as financial managers. The first is, what long-term investments are we going to make? So what are the products and services that we're going to make? What's the firm's general business going to be? The second is, how are we going to finance those products and services, those long-term investments? Where are we going to get the funding for the assets we need for our general business? And finally, how are we going to manage our everyday financial activities? So our cash, our accounts payable, our accounts receivable, and our inventory. So that first question, what long-term investments should the firm take on? That we call our capital budgeting decision. So when we're deciding what our firm's general business is going to be, what projects we're going to take on, what are the new products we're going to make, what are the new services that we're going to offer, all of those are called capital budgeting decisions. The second question, how will we obtain the long-term financing to fund those long-term investments, we call our capital structure decision. So capital structure is the mixture of debt and equity in our firm. So if we decide to fund our projects with debt or our long-term investments with debt, we could be taking on a loan from a bank, or we could be taking on a loan from a syndicate of banks, so a group of banks, or we could be issuing bonds. Now we could sell those bonds privately, we could also sell them publicly. And then that would mean that our firm would take on more debt. So we would have a higher percentage of our assets financed with debt. We could, on the other hand, decide to sell equity in order to obtain funding to finance these new projects. So if we're selling equity, this means that we're selling shares or ownership of our firm. We could do that privately, or we could also have an initial public offering or even a seasoned public offering. So this means that we're selling shares to the public. So anyone who wants to be an owner of our firm can just pay us for the shares. And then in that case, we would be selling equity. And so our capital structure would have a higher weight of equity. That means that more of our assets would be funded with equity versus debt. So when we say, for example, that a firm has 60% equity, we're talking about the firm's capital structure. And that would also then mean that the firm has 40% debt. Again, we're talking about the firm's capital structure. What's the mixture of debt equity within the firm? And then the third question was about our managing of cash, accounts receivable, accounts payable, and inventory. So that would be our working capital management decisions. So how will the firm manage its everyday cash, its current assets, and its current liabilities? Remember that this is a really important decision for us, because even though we may be profitable on paper and have positive net income, if we don't have enough cash to pay our bills from day to day, we could face financial distress, and that could put us out of business. So we want to make sure that we've got a cash budget, that we know how much cash we need every day, and we can forecast when we're going to have cash surpluses and cash deficits. And when we're going to have a deficit, we're already ready with some form of financing that's readily available to us. In terms of managing our current assets, that means managing our accounts receivable, so how long are we going to give our customers to pay? And remember that if we give them a long time to pay, that means that we have less cash on hand, or we'll have to obtain that cash from somewhere else. So we may have to borrow in order to give them a long time to pay. Managing our current assets also means managing our inventory. So how much inventory are we going to have on hand? And when are we going to order new inventory? How long is it going to take to ship to us? How long is it going to take us to organize it so that we can use it? And finally, managing our current liabilities. So how are we going to go about negotiating with our suppliers so that we have more time to pay? Because the more time we have to pay, the more cash we have on hand. So this is a very important decision for the firm. So again, the firm's three main decisions are capital budgeting, capital structure, and working capital management.